So you will learn role of debt instruments in stabilizing your portfolio, importance of equity exposure to enhance your returns in the portfolio, and the purpose of derivatives as the hedge against the market falls, and purpose of derivatives as an income enhancer as well if you treat it well. Hi, if you are watching this video, you should know that we are going to talk about IFEF approach, which is income flow engine framework, and we will explain that in a moment. But before that, there is some context which I want to put up first. If you are trading the options most retail traders do, then you are paying the market first, and after that hoping that the trades executes well and you get the returns out of it. You buy calls, you buy puts, and then you chase breakouts, you watch the screens all day, but still there is no consistency of the profits, and slowly your capital erodes away. Let me ask you something. What if instead of chasing the returns, you design the returns? Yes, you heard me correct. You can design your returns whatever you want, and there is definitely associated risk along with it, but we will manage the risk. And what if market pays you first instead of you paying to the market, and then you manage that payment which market has done to you so that you don't have to release that payment again? So that is the game in IFEF approach. This single aspect changed the entire game. Most traders in the stock market don't lose because they don't understand the strategy, but they make losses because they lack structure. If you have ever traded in F&O, you would likely have experienced inconsistent profits, emotional stress, overexposure during volatility, and your idle capital waiting for the deployment, fear of assignment when market goes down, confusion around how much capital is required in a particular trade, how much capital should be sitting idle, how much capital should be there in F&O altogether, how much should be the overnight risk you are going to take, and screen addiction for the whole day without proportional returns. So what is the deeper issue? Deeper issue is nobody teaches you the capital allocation, nobody teaches you capital structure which is required during the trade in future and options. People might have taught you the trades but not the proper structure, without which you will always remain confused. Let me talk about two kind of market participants. One is the trade chasers and second is the capital designers. Trade chasers focus on the entry signals, exit signals, and the capital designers focus on the flow of the market, flow of the money in the market, flow of the money out of the market. And our IFEF approach belongs to the second category, which is capital designers. It is an income first model where you harvest the premium first, then you recycle that premium. Also, you try to save that premium within you so that you don't have to pay it back. You also adopt different other peripheral approaches so that you can enhance your return as well. Now let's address something which most retail traders fear, and that is called assignment. So this assignment sounds very dangerous, but what is an assignment? So let me explain what is assignment. Suppose there is a property which has a market cost of 1 crore right now. Now you make a commitment to the dealer that if suppose market sells off, market falls down, and if this flat comes at 80, if the price of that property falls, if price of that property falls back to 80 lakhs, then you are making a commitment that at that point of distress you are going to buy that property from that builder. So he will be happy. So the builder will be happy with the approach, and suppose because of that commitment which you have made, he is willing to pay you some kind of premium. Now there are two things which can happen. The price of that property never comes to 80 lakh. In that case, the premium which builder is paying to you, you will just keep on harvesting that premium. You will just keep that premium with yourself and you don't have to pay anything else. And suppose market crashes and that property comes to 80. At that point of time, you will be happily buying that property for 80 because you feel that it was earlier at 1 crore. So sooner or later, it is going to reach at 1 CR, and then you will be getting the benefit out of that property. So that is the assignment which you took at 80 crore, and this is not the punishment. This is the market cycle which you are going to take advantage of. How you are going to take advantage of those scenarios in real stock market, we are going to tell you all about that, all in details. So what happens in practicality when such scenarios happen? Market is crashing from 1 CR, it has gone down to 80 lakhs. Then traders panic and they exit the situations regardless of the future potential of that particular deal. We need to have our psychology very clear, and we should be able to see through the things and take the decisions accordingly, not emotionally. So what this strategy involves? It involves income generation before you even own the thing. In case you have to buy the assets, you buy the assets. And there is lots of flexibility in the actual trading decisions based on the returns that you want, based on the risk that you want to define for yourself. This is a continuous income generation technique. How you are going to do that in practical terms, we will tell you everything, every single detail around it. How you are going to do the margin optimization, how you are going to manage your overnight risk, and what is the flexibility in the risk and return, what additional returns you can earn, and what are the means of earning those additional returns. All of that is part of this IFEF framework. You can design for aggressive returns, you can design for conservative returns, and similarly based on both the situations, your risk profile is going to be different. If a person has lots of capital and a part of capital is being invested in future and options, and a part of that capital is being invested in stock market and future and options, higher returns possible for that person because he is able to take higher risk because he has got other other capital avenues as well apart from the stock market. But if there is a person who has entire capital, limited capital in the stock market, his risk reward will be entirely different because he has to define his risk accordingly. So that's where he need to learn the things. Now let's talk about the key missing piece in this puzzle, and that is the capital architecture, and that's the complete missing thing that nobody explains about. So how much capital is actually required? How much of that is going to go into the equity? How much will be in the debt? How much will be in the overnight positions? How you are going to divide that capital allocation? Are you going to put 100% of your money in the derivatives? And that is going to be the reckless decision. It can wipe you off in one night. What is the minimum capital that you are required to make IFEF possible for you? What capital size is inefficient? Is it scalable? If you are able to adopt a strategy with 25 lakh capital, can you adopt the same strategy when you are deploying 2 crore capital? Why you should put some amount in equity? Why you should or should not put some amount in debt? So all the concepts will be explained to you clearly, and you have to take your own decisions based on the merits. Every decision will have its own drawback and benefits, so you need to choose that. So you will learn role of debt instruments in stabilizing your portfolio, importance of equity exposure to enhance your returns in the portfolio, and the purpose of derivatives as the hedge against the market falls, and purpose of derivatives as an income enhancer as well if you treat it well, and how to balance all of these three aspects very intelligently so that you earn additionally in a passive way from the market. When the capital is divided properly, your volatility reduces, your chances of returns enhances, your drawdowns become smooth, and the returns become more stable. So the question is not about what is the return you are going to get. The key question is what is the capital structure you are going to adopt for your trades. And the beautiful thing is that this approach works equally well for the stocks, equally well for the index as well. You pick up broader market index or you pick up the quality stocks from the market. It works for both. IFEF methodology explains you exactly when to use index, when to use stocks, and how to evaluate suitability. What is the volatility level? What is the stock level? What is the index level at which you are going to execute your trades? And now the very important aspect, how much time commitment do you need for that? So this is not the intraday trading. You don't have to provide your reaction to every tick. You just need to have a minimum kind of monitoring for your portfolio, which you anyways do just in case if you have invested in the stock market. It is for the people who are professionals, who have the businesses, who have the families, who want to earn additionally from the market and want to stabilize their returns in the stock market in the bad times as well. This approach supports your life. It does not consume your life. And in the ideal situation, this approach is going to enhance your returns so that the compounding effect of those additional returns multiplies in the years to come so that you become financially free. And it is strictly not recommended that you resign from your job, close down your business to jump into these strategies, to jump into the future and options, to jump into the stock markets. It is not recommended. What is recommended is that you are having one avenue of earning. You deploy the earning from that avenue into the stock market. You deploy that capital into the future and options, because potentially this is going to provide you the best returns which you can get. There are risks, certainly. You need to learn that. You need to keep that all in mind. Now let's discuss about risk as well. So let's be mature about it. Markets may crash, markets may shoot up, volatility can spike, and the assignments can occur. Margins can change because of different regulations. So these risks exist, but here is the distinction. We are not saying that we eliminate risk. Risk cannot be eliminated, but we design around the risk. We empower ourselves to take advantage of those risky situations. We will define capital allocation. We will define trading phases. We will define when to take trade. We will define when not to take trade. We will define our risk profile. Higher risk could be higher return. Lower risk could yield to lower return. How much should be your overnight exposure? How much should be your exposure to a particular instrument? So we move on all of that with proper discipline. So the difference between traders and the professionals is in their positioning. Traders try to double their money every month, and that's where they suffer the most. But the professionals look to compound their additional return. They compound it year on year so that it builds into a substantial additional amount. And the outcome for the professionals is not the gambling kind of return. Outcome for the professionals is enhancement to their return. So who is this? So IFEF approach, who this is for? So this is for the working professionals or the business owners who are looking for a second structured income approach. It is for the investors who are looking for discipline, who wants to have the benefit of hedging and additional returns from the future and options market. And it is for the traders who are tired of emotional cycles. And yes, certainly if you learn it well, and just in case you have to lose your job, then you can support your families by earning through these methodologies. And this is strictly not for those people who are seeking gambling, who want to earn 10-20% return every month. Certainly you cannot earn that. So to summarize, inside the masterclass, what I am going to teach you, so we are going to talk about premium initiation, we are going to talk about assignments, we are going to talk about heightened volatility, when to enter the trade, when to exit the trade, when to keep out of the market, what should be your capital structure structure, how much you should put in debt, how much you should put in equity, and that kind of structure. We will be providing you the framework to define your risk and return profiles. We are going to provide you the time efficient trading system. So I invite you to join us in this journey. Let the market pay you first. Thank you.